So much talk about real estate. What could trigger a real estate plunge in Canada? Well, we've got a live webinar happening. It's absolutely free. Just go to moneytalks.net to sign in. It's right after the show. The housing market, so many people are talking about that it fits the profile of a bubble, but you need a trigger to burst that. Well, Patrick Ceresna, of course you know him from Learn to Trade Global, is going to chat about what may trigger that plunge, but how you can protect yourself and how you can play it. It's going to be kind of interesting. Right after the show, go to moneytalks.net, click on, and join the free webinar. Time now for this week's Quotes of the Week. And if there's anything I love the response from the status quo when the power groups get threatened. And it doesn't matter if you're a business monopoly or in government, or in this case, talking about the Brexit vote coming up. As I said earlier, 170,000 bureaucrats in the European Union are being challenged. That's the status quo. So in response to the threat that Britain may leave, you've seen the polls going up and up for the leave side. Well, we got the predictable cries of Armageddon. I loved it. The International Institute of Finance stated this week that a Brexit vote to leave would be a bigger threat to the global economy than Lehman's collapse. That, of course, was the catalyst for the entire credit crunch. Okay, that's one. Don't vote to leave because it's going to be like Lehman's. Next up, you got British Prime Minister David Cameron said that Brexit, are you ready, would lead to world war. That's a bit of a stretch, but not to be outdone. The EU President Donald Tusk stated that a vote to leave could spell, in his own words, the end of Western political civilization itself. Wow. Talking about using the scare tactics a little bit late. Joining me now on the line, very pleased to have back to the show, I've got Bob Hoye, Institutional Advisors. What a perfect time to have, Bob. Bob, appreciate you finding time for us.
Mike, good to be with you and with your listeners.
So much to talk about, but let me just start with the Federal Reserve's decision this week. Once again, we're not raising interest rates. Yeah, I know we said we would 4 times when we were in December. Yeah, I know we said we'd continue doing it. And then it was going to be June. Then it was, nonstop. Is there a message here? I mean, that they didn't do it again. What should we take from it?
Yeah, the message, Mike, is that the Fed is finally being seen to be ineffective.
Yeah.
And they also, I think, in the last few weeks have realized that they're ineffective. But we should look back at the history of, at least since the 1870s, on great financial manias. The senior central bank, which was then the Bank of England, was about 4 or 5 months behind the natural change in interest rates. Mm-hmm. So anybody who's sitting there figuring that the Fed knows what's going on, that's improbable. And that they can make an effective policy, and that's improbable. So, in the 1930s, the T-bill rate went down to 0, and it was because the Fed was forcing money into the markets, and the money wasn't being employed in industry. And so I was looking like in 1937, it went into the stock market. So this was the problem with central banking: is they're not connected to reality, and the main issue is that the public chooses what to speculate in. So you had the Fed incredibly easy during the 1970s, and the big speculation was in commodities, consumer price index, and wages. And then everybody got turned on to that and said gold was going to go to the moon. And then in 82, the financial world shifted over from speculation in tangible assets to speculation in financial assets. And we've been in financial assets ever since. And no matter how hard the Fed pushes in hoping to get an expansion of GDP, the money will go where the public is speculating. And for the last few years, it's been in low-grade bonds, a brief run in commodities, and not so much in gold until recently. So, and plus real estate, high-end real estate. So this is a demonstration that the Federal Reserve is not hooked to reality. And I think that we are looking here in the financial markets where the change is going to be. Already, the yield curve for the last 5 weeks has turned to flattening. That is not good for the banks. And, of course, the Federal Reserve has no influence on when the curve is going to change. And then the other one is that you've had a terrific narrowing of credit spreads since the catastrophe in January. So first part of that was due to, the rebound out of a distressed bond market. And then the next phase, which is right on until just a couple of weeks ago, is there's a seasonal narrowing of credit spreads. So we've had that terrific narrowing of spreads. And some spreads for the last 2 weeks have turned to widening. And the main one we watch, which is the Triple C against Treasuries, it's just had a week of beginning to turn. So this is what guided us in 2015. That changed there. It was widening credit spreads that pushed off the problem in Shanghai. Nothing to do with policy of the Chinese central bank or the Federal Reserve. It's just the natural change to widening spreads. So to debate where the Fed is going to go with policy isn't going to be helpful.
It's interesting, and of course, let's not forget they're the only game in town. I mean, one of my statements, at least, is that how hard governments work against economic growth. They talk that game, and you turn around and you watch them with higher taxes, mandatory transfers, talking about it right now with more transfers to government through Canada Pension Plan. Everything takes money out of the system. Then you got the regulatory burden. So I think the Feds sit there and the central bankers think we're the only game in town. But as you say, Bob, they don't have control of, they lower rates. They can't tell me what to do with that money. And now you throw that Brexit vote on, and look at that stampede for safety. I mean, the U.S. government bonds. I saw, we saw it in Germany. I talked earlier about those Swiss bonds maturing in 2049, now gone big time minus. I just see this system as not solvable at this point.
The only thing it'll solve is to get rid of the artificiality.
Yeah.
Now, financial markets, private, without an aggressive central bank, can get highly speculative on their own. Mm-hmm. And then usually it crashes. But what you have here is that not only have private investors become speculative, but the central bankers, first of all, the theory that they can successfully intrude in the marketplace itself is highly speculative. Then the other one is that they've taken their usual push a bit, pull a bit here, and stretched it to infinity. So it is three levels of speculation: private, a speculative theory about intervention of central banking, plus those central bankers going absolutely mad. So they can't win forever, and what we're looking at now is a seasonal turn to widening credit spreads that worked for us in 2008, 2007, and even in 1998 when long-term capital management was discovered to be on the wrong side of a trade, and it was just the seasonal change to widening credit spreads that brought that down.
What's the implication of that then for investors? What should they be looking for at this point?
Oh, I think that the long-term treasuries and Government of Canada's now are on an uptrend. The treasuries we used, the TLT, got up to 135, which was a target, and it'll exceed as commodities get a bit weaker in here. But these yields are exceptionally low, or prices are exceptionally high, so it's very difficult for investors to find a place to park. So what we suggest in the for safe money is get in the 3 to 4 year treasuries, the U.S. treasuries for Canadian investors, because it looks like the U.S. dollar is about to start to take another leg up. So then, sure, you got low yield, but at least you'll make a little bit on the currency trade. Now, on low-grade stuff, it's going to be another disaster. There's also seasonality in there where the best may be around May or June for low-grade credits. That the worst can be found around October or November, and you've had excesses again here now in the credit markets that Mother Nature is going to tend with. So,
I'm talking with Bob Hoye with Institutional Advisors. Just go to institutionaladvisors.com. I'll come back with Bob. We'll talk more about what it all means to you, but I just heard a very big warning, a very big lookout. We'll chat more about that when we come back on the Money Talks Network. Coming up, my favorite story I read this week, a new way to sell a business. I'll share with that in just a couple of minutes. Right now, though, very pleased to have with me Bob Hoye, Institutional Advisors. Bob, let me just come back. You were certainly hinting on it before we took a break, and that is, what's the biggest danger area for individuals and their investments?
Well, first of all, government. But one of the things is any price that is excessive now, and the price of high-grade bonds are exceptionally high. They may stay high for a month or so yet. The price of low-grade bonds has been exceptionally high. They've had this year, the last few months have been very good, so they're high. And the price of residential in Toronto and Canada is exceptionally high. So the danger is to join the crowd on a very popular trade, and there are other things to do, but the problem is in the real estate market, if a young person does not yet have a house, you're going to be forced to save enough to get in, but you can't trade your house. But these are the areas that are exceptionally high priced, and in a few years, like you can't call the trade for tomorrow, but we know that high-end residential real estate in England has suddenly gone no bid, and the same in New York, in Manhattan. It's suddenly a glut of both rental and condominium stuff. So it looks like the mania in residential housing has become overdone and is beginning to at least go sideways to slightly down. So I would say to younger people, just avoid excess and don't join the crowd, as in, hey, all the lemmings are doing it. So, and the places where you have reasonably good opportunities is that in every post-bubble contraction, which we're in, the bubble really blew out in 2007, and we're in the first business expansion and first bull market out of that crash. And as a matter of fact, our view is that the bull market peaked last year, and this is just a rebound within the bull market. And so in the post-bubble contraction, deflation is a problem. You have weak commodity prices, which other than a bounce this year, you have. And eventually you get real interest rates rising. There's lots of noise now about negative interest rates. That's for a nominal yield where you will buy a bond and you get less money back when you have it redeemed. But the way to clear through that is where we take the nominal interest rate, which is the one that's published day to day or month to month, and divide it by the consumer price inflation, and they call that real interest rates. And it follows a regular pattern through a financial mania where real interest rates go down, and this has been the case recently. It was certainly the case in 2007 where real long interest rates, and for this we stay in the senior currency, so real long interest rates in U.S. terms with the 2007 bubble fell to about -1, -1.5, and then it got up to 3%. So you had about a 4 or 5% swing increase in real long interest rates in the contraction 2008, 2009, and that was rather severe. But if you look back in the history of real long interest rates on each bubble, the typical increase in real long interest rates has been 12 percentage points. Mike, 12 percentage points is a huge increase. And it seems to be a trap that Mother Nature puts in the markets because the financial mania is, no matter whether it's a central bank involved in it or just regular people and corporations, is a building disaster. And so what happens is that Mother Nature likes to correct excesses in the financial markets. So in the past post-bubble contractions, real interest rates have gone up at the high-grade end by 12 percentage points. So that is a brutal way of stopping the abuse of credit markets. And then on each of those ones, the markets went about allocating credit, and also the other part of a post-bubble contraction is that the senior currency becomes chronically strong relative to most other currencies and to most commodities for most of the time. And this, of course, has been the issue is here, like the Federal Reserve is boosting the credit markets, hoping to get inflation up, which means hoping to get material prices up, producer prices, commodities, and other than some swings. It's not happening. So this all comes around to a circle whereby the Fed is pushing and the markets are not following according to the rules of the Fed. And this is where I think this week's Janet Yellen announcement was a lot of critical analysis that said that, look at gals, it's not working. And so also this is where we think that once enough asset prices declining, then that shuts the door on the Fed trying to get credit out the window. They need outside speculators to borrow money aggressively in order to get their portion of credit expanded. And it'll go back to the 1930s where the description of Federal Reserve activity was pushing on a string. Hey, it doesn't work.
Well, I think that's certainly the hint that we've seen. I mean, my gosh, we're just doing the same stuff. We haven't had the result. We've had unprecedented central bank action, unprecedented in terms of quantitative easing, record low rates, all of that stuff, and you still look at the level of economic growth. It just hasn't worked. But Bob, time is out here, but I just want to reiterate. So you like the U.S. dollar there. Let's be careful. At some point in the near future, you're going to be locking in your borrowing side of things in anticipation of a jump in rates. So, we're in that time frame now to be worried about that.
Well, we've got a special study on real long interest rates, so people can tap into the website to have a look.
That's institutionaladvisors.com. Bob, as always, we so much appreciate you finding time for us. Fun
to be with you, Mike.
Bob Hoye, one of our favorites. I just should have started with this. I remember Bob coming on with us right at the top of the Dow, 2007, 8, and he says there's going to be a credit tsunami happening, the likes of which you will not have seen in your lifetime. And, of course, the credit crunch showed up right on time for Bob. Pay attention to what he's got to say. Go to institutionaladvisors.com. Lots still coming your way here. Just a reminder that we've got, what I'm always interested, what comment sort of solicited the most reaction? I'll share that with you when we come back. I've got a shocking stat for you. It's actually a fun one, though, for a change. I got Aussie Jerk. We're talking more about real estate. And right after the show, we've got a special free webinar. Go to the Money Talks website. We got a free webinar on what could prick the real estate bubble, as Bob was just alluding to, plus Victor Adair live from the trading desk. As you can tell, that was a mouthful, but there's a lot of good information coming your way right here on the Money Talks Network. Coming up right after the show, Learn to Trade Global's Patrick Seresna is going to do a webinar. You just go to moneytalks.net. You can click on it. It's free. Only 500 people, though, I think, with that platform we use. But what could trigger a real estate plunge in Canada and stuff you can do about it? Very interesting. That's coming up right after the show at 10 o'clock. Time now for Hate Mail of the Week. That's always an interesting thing to say on my part. But I am always surprised at what gets the reaction, what threatens people when they hear it. To the extent of saying, hey, I'm uncomfortable with that, but no, I don't like you because you brought it up. I'm going to share this week's with you right now. Go ahead and play it.
One of the most impressive things I see from virtually all politicians, organized labor, the educational establishment, hello Vancouver School Board, is the commitment to ignore the changes going on in technology and the implications for employment. I mean, that's got to take a lot of effort. The substitution of self-ordering kiosks, robotic delivery, self-driving vehicles for workers has already started in earnest. Walmart announced earlier in the month that it was pushing to introduce drones in warehouses. Amazon already uses an army of robots in theirs. But it's not just low or semi-skilled jobs. As a just-released report by Ryerson University's Brookfield Institute for Innovation and Entrepreneurship concludes that innovations in artificial intelligence and robotics puts 42% of Canadian workers at high risk of seeing their jobs disappear or at least significantly changed in the next 20 years. That's actually more optimistic than McKinsey Consultant report in March that puts the number of jobs at risk much higher. Quick example, this week, robot receptionists were introduced in 2 Belgium hospitals. The same robot, named Pepper, is already being used in Japanese and French malls. Smaller robots are employed as support staff in 300 hospitals and care homes around the world. Now, if the consequences for employment of ignoring the tech revolution weren't so serious for workers, it would be laughable. I mean, these power groups are intellectual equivalents of platform shoes, bell-bottoms, and headbands. They could be sitting in a restaurant after being greeted by a robot, ordering on a kiosk, asking Siri a question when Pepper brings their food, while they still look at an online catalog featuring drone delivery, and they'd still ask, "What time is I Love Lucy on? Adjust the rabbit ears, dear."
Just another reason why I'm not on anyone's Christmas card list, but it is incredible. I've been begging for years. I don't care what your conclusion is, but to suggest it's business as usual when we have our policy discussions is absolutely, it's gone to the obscene level. Time now for this week's shocking stat, and it's a good one for a change. Oh, do I dream about doing this? I've just been mentioning we've got the Special Olympics auction online right now. If you just go to moneytalks.net, it closes on Tuesday. So many great things and so many companies donating their time. But really, it's the key is this. This is your chance. You want to be better looking in life. You want to be more intelligent. You want things to go well. Well, sign on to that auction and make your bids, make your donation if you choose instead to do that. Just go to moneytalks.net. It's front and center there. Is there a group that deserves it more than special needs individuals? We're talking about helping children, talking teens, adults with intellectual disabilities. Nobody does it better than Special Olympics. I always love to give people the chance to actually take action. But that relates to my shocking stat of the week. Of course, Warren Buffett, for 17 years, somebody came up with this idea and he was on board with it. For 17 years, he has donated a lunch with Warren Buffett. And of course, all the proceeds go to charity. And it's incredible. Think about how much you'd pay for that. So it's lunch with Warren Buffett. 100% goes to a charity named Glide that helps the homeless and poor in San Francisco. Guess what it went for? $3,456,789. That's what it went for, $3,456,789. Second year in a row, it's gone for over $3.4 million. I love that. Love to hear the charity benefiting. Then I got depressed. I thought about myself. I'll offer lunch for myself. Oh, I might get about $12 for that. That's because I'm paying for lunch. But that's a great shocking stat, positive one. I'll come back in a minute. Ozzie Jurek, he's going to talk about what things bring up the price of real estate that don't make the headlines. Also, Victor Dare, live from the Trading West. He told us a few weeks ago that, oil had peaked out at $51. Hey, that looks a pretty darn good call. Talk more with him. And I got a Goofy Award for you. All of that in the Money Talks Network. Money Talks is brought to you by Solera Club. And again, you can go to soleraclub.com. They're a royalty-based investment. You don't pay any fees attached to it. And as I say, soleraclub.com. Let me bring on Ozzie Jurek right now. Ozzie, I always like this with you, and I've got to spring this on you. But, of course, there's so much talk this last week or two. That was silly. It was this last couple of years, but in heightened this last week when they talked about the Vancouver market, talked about parts of Toronto, affordability. So I always like to throw it out to you. Give me something affordable in that metro area.
Well, I love the Fraser Valley and I love Surrey. 1,200 people a month move there, right? So we have a 3-bedroom, 2 full baths, 2-level townhouse, 4 parking spots, fully fenced yard, onto the green, large bedrooms, private master bedroom, balcony, and it's on at $219,000.
Wow. 4 parking spaces, my goodness. The guy's starting a car lot. $219,000. Good one, Ozzie. You got me on that one. Hey, but I want to talk more about affordability here. And one of the things that I smiled at is when people say government should do something, and I say they've already done too much. And I'm talking about especially development fees. When you want to build, we have a huge supply problem. So someone comes to build a development, condo complex, that kind of stuff. And I don't think the regular public understands how much the cost of that unit when it comes to selling it incorporates some pretty significant fees. I mean, whether it's $25,000 or $40,000, to build, for example, a new detached home in Vancouver, compared to Burnaby alone. Or you've got, I did some numbers about 6-8 months ago. You take a 800 square foot building in a brand new development. Well, it's about $76,000 in those kinds of fees throwing onto the cost. So, and now I hear the city of Vancouver, for example, is planning to do more.
Yeah, in fact, we have sort of this strict green-tinged Vancouver building bylaw, which is the only city in the province with a building code than the rest of the province. And on July 12th, the Greener City Action Plan Committee will present a new set of building guidelines, which, if enacted, and it likely will even higher cost to the new condominiums. Now, I'm not against rules, Mike. Green used to be if your engine oil in the elevator shaft was green, the whole building was green, right? So we have to have some rules. I'm not against that. But we're already the highest priced real estate market. Is now the time to even add more green stuff onto our building sites?
Well, it really shows the hypocrisy, though, of the debate. That exactly that, Ozzie, that we have the most or least affordable market in history in Canada, and yet they're talking about doing some things, and you're right, it's about timing. Is now the time to throw that on? Now the time to make it more expensive? And all I'm saying is people can have their own opinion on it, but they should know that's what's going on.
Well, that's right, and it becomes a law, right? I mean, new thermal breaks on concrete condo balconies because supposedly some heat leaks out from building through it. Every new condo apartment has to be equipped with its own heat recovery ventilator, which is now only required for common areas, and stop pouring in placed concrete construction in favor of precast insulated wall panel construction. Mike, I don't know that much about it. Maybe it's all fabulous, but sometimes those new ideas, when we brought in the put the insulation in the walls, R2000 construction, it resulted originally in the leaky condo crisis, and we need this at this time. That's the point I'm trying to make.
Yeah, what about existing condos, quickly?
Same thing. The existing condos already, the small renovation program and the tenant improvement program has very similar. Whether it's demolition permits and so on, it's much longer time frame because you need field review and energy documentation. It's really become very, very difficult.
Bottom line, what's this going to cost?
Yeah, a lot more. I mean, we already have in Vancouver high-rises at $210 to $270 a foot, plus land between $200 and $400. I mean, Vancouver may eventually be the greenest, but maybe also the most unsold condo towers.
Yeah. Well, I think that's just absolutely fabulous information. It's the kind of thing that's not out there in this public debate. Very few facts are. It's an emotion-driven debate at this point, but I think those are key facts to bring to people's attention. They can then choose to support, not support, but just know what's going on. Hey, Ozzie, one final hot property for me.
We got a real hot one in Fort St. John. It's a brand new unit. It's completed at the end of this year. There's only 3 actually remaining. They're now $270,000, 2 bedroom, 2 baths, 5 appliances, hardwood floor. There's $9,500 that has been knocked off the price, and there's 3-year financing offered at 1.49%. So that looks like a good deal to us too.
Pre-sale at Fort St. John. Just go to Ozzie's site, Jurock.com. So much great information, by the way. You're interested in real estate. Jurock, Jurock.com. Ozzie, thanks so much. I'll see you at the Special Olympics golf tournament. You're a player, you're a donator, you name it. Ozzie Jurock will be there with me. Thanks, Ozzie, for the time.
And I know I'm getting better, Mike, because I'm hitting fewer spectators.
There you go. And that's a happy time for everyone. Let me just say this, Ozzie. Absolute guarantee, anyone who donates, bids on that site, go to moneytalks.net, click on the auction site there. I'm telling you, with the survey results are in, 93% of people who do that are better looking the next morning. So there you have it. Thanks, Ozzie.
Thank you.
I'll take a break. I'll come back live from the trading desk, plus a Goofy Award, all of that on the Money Talks Network. Man, it was a busy week this week. I guess I can say that every week. It's hardly insightful on my part, but I'll tell you, we've got so much stuff happening. I've got Victor Adair joining me live from the trading desk right now. Victor, I've got to come back. We chatted about it today, but it's interesting me that it's still in sort of the mainstream media, isn't getting enough press in Canada, and that is the Brexit vote. We saw all sorts of movements in the markets as they anticipate what's going to happen there, but it's an example of this sort of key event, a political event, I guess we can describe it, that's going to have huge financial, economic implications.
Well, Mike, certainly in the short term, markets can get very emotional, and when you're very emotional, you can get very irrational. And certainly the UK Brexit vote, which is coming up this Thursday, is a great opportunity to get very emotional. And we did. We I'll tell you, it was a long week. The gold price is up $110 from where it was 2 weeks ago, leading into Thursday. Interest rates just falling like crazy all over the world. You and Bob talking about that. And by the way, thanks for having Bob Hoye on. He's pointing out to people, pay attention to real yields, and I think that's a great piece of advice. But here's a take on the UK referendum I don't think we're hearing, and that is this. This referendum is a non-binding referendum. In other words, even if the people vote to leave, there's not some giant pair of scissors come out of the sky and cut all the ties between the UK and Europe. You can bet those 170,000 bureaucrats that you talk about are going to do their very best, to keep things cooking. So I think the markets got very emotional about this thing, but it's not just going to be something that's going to happen, all of a sudden. And by the way, the bookies still say the vote is going to be Remain.
Yeah, it is interesting because I think it's going to come down to who actually shows up to vote. It's very easy to respond in a survey question. Someone telephones you or it's an internet thing. It really comes down to what the voter turnout, what their preferences are. I still think it's fascinating, and I actually don't think it matters which way it goes, Vic. I just think it's going to represent a further chapter in the demise of the European Union. There's so much pressure there. I mean, Greece should have left. Sure. That thing ain't working out there. So, they still have huge financial problems. I think the mishandling, and I don't even have an adjective to describe how incompetent it's been. Mishandling of the refugee situation has created phenomenal political tensions, a huge rise in those kind of anti-immigration parties. No, this is not the end product here at all. It's just another check mark for me on the road to disintegration there.
I agree with that, Mike. And we're trying to navigate markets, and markets get buffeted. Prices go up and down because of all this stuff. I'm making the point. The markets really got emotional this week, but the fever seemed to break. On Thursday midday, and we had a lot of things that were going down, and went up, and vice versa. I think if there's one market you really want to pay attention to here, it's crude oil. Mm-hmm. Crude oil hit a high there, $51.50 thereabouts, with an extra kick to the upside with the fires in Alberta, supply disruptions in Nigeria, other parts of the world. Since then, prices have fallen about 10% or so. And why I think that's key is, again, go back to Bob Hoye. There's been so much debt issued on the back of crude oil, and a lot of speculators have jumped in there looking for an end to the bear market that we had. We've had a great rally here for the past 4 months. If the crude oil market starts to turn over, I think that goes right to the heart of what Bob was talking about, widening credit spreads, and widening credit spreads are not good for the stock market.
Well, it's interesting. I mean, you certainly called that a few weeks ago when it bumped above 50. You said you kind of had that feeling that might be it for that move. It's certainly been a good call at this point, and a key, obviously, for Canada also. I mean, as I say, so much happening when Janet Yellen pulls in the horns on midweek saying the economy's not strong enough, worried about the Brexit vote. I felt like it was Groundhog Day. They've done that so often. And I just watched stuff just moving around. Just give me 30 seconds on your short-term positions.
On my short-term trading positions, I am short of crude oil. I am short of Canadian dollars. They're kind of the same trade in a lot of ways. I am short of the euro dollar. I own some out-of-the-money puts on gold that are so far out of the money they're worthless. By the way, a huge jump in the speculators getting into the gold market. I got to be watching that. I think it's a little bit vulnerable. And Mike, just to close, I mean, it's kind of an Alice in Wonderland world here where people rush to put their money in Japanese yen and in government bonds that pay you no money, and they're doing that because they're looking for a safe place to go.
It's unbelievable. Victor, thanks for taking the time.
You bet, Mike.
Time for this week's Goofy Award. And remember, Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment. You get paid first. Keep in mind that there's no fees, and it's in the tech sector. For more information, go to soleraclub.com. Thanks to Daniel Macadama, who brought this to my attention. This is incredible. I mean, the tragedy of what went on in Orlando. I mean, I personally don't have words to describe the killing of 49 people. the way they were gunned down. I'm hopeless at that kind of stuff because I find it overwhelming. But here's the thing. Right in the aftermath, U.S. Secretary of State John Kerry, he sat down for dinner with Saudi Prince Mohammed bin Salman in Washington. And according to the State Department, they actually discussed the Orlando shooting, and they expressed their commitment to continue to cooperate in battling the spread of violent extremism, both regionally and internationally. Are you kidding me? Saudi Arabia? This is a country that condemns homosexuality, wouldn't treat them any differently. This is a country that has fostered the kind of violent extremism that's been highlighted throughout the world in certain areas, certain aspects of terrorism. And they're going to now help? I just found that too much to handle. That was just too much for me to swallow when I hear Saudi Arabia talking about getting together with their track record on extremism and on the treatment of homosexuals. Sorry, absolutely no sale there. How could they possibly have said that? Hey, just a reminder, right now, right after the show, you can go to moneytalks.net, you can click on and you can hear Patrick Ceresna from Learn to Trade Global talking about what could trigger a real estate plunge in Canada. But while you're there, please participate in the Special Olympics Gold Corp Invitational Auction. Great companies like Turtle Bay. Can you imagine 4 nights in that spectacular place, and horseback riding, mountain biking, playing on the Arnold Palmer Golf Course. Thanks to Do It Auto Group. What a fabulous package they've got. You actually fly down to the Seahawks game. All special treatment there. It's incredible. Thanks to Gold Corp and thanks to so many other participants. I'll be there myself bidding. I hope you join me in that. And as I say, I promise there's a ticket to heaven waiting for you. Thanks for listening. We'll see you next week.